Excellent. I'm going to call to meeting the pension board to the city of Norwalk on June 14th. And is there a motion to accept the minutes from the previous meeting of May 10th? Are there any amendments or adjustments?
I move to accept the minutes.
The second, all in favor? Aye. Opposed? No. Any public comments? As usual, there isn't. Thank you very much. Without that, approval of pension applications. We have two pension applications. Before we go to them, we'll just say that the two, you don't have to read the pension applications, but there were two disability pension applications that the disability board recommended that the board accept. And is there a motion to accept those two pensions?
I move that we accept both of the
Any
pensions.
second, all in favor? Aye. Perfect, so they're approved, okay. And now if you want to go over Charles Horner and Daryl Shepherd, that would be excellent.
Sure, thank you so much. So our first pension application is Charles Horner, who worked for the Board of Education as a custodian. He was with the Board of Ed for 19 years and 7 months. His last date of service was April 18th of 2023. He's seeking a regular pension with standard options. And we also have Daryl Shepherd, also with the Board of Education as a custodian. He separated from the Board of Ed on March 27th of 2023 after 13 years and 2 months. He's seeking an early pension, and his option selected was option number 3.
You had one question
No,
on,
it's okay. The application itself has a subsequent.
okay,
So, Mr. Chairman, I move we approve both pensions as of the dates listed on the approval form for Charles Horner as of April 19th, 2023, Daryl Shepherd, March 28th, 2023.
excellent. Is there any discussion? If not, a motion to,
Motion to approve.
all in favor? Aye.
Aye.
Opposed? Perfect, thank you very much. The next item is discussion of pension. What are we going to do about our continuation for consulting services? Should we have these guys out of the room or not? You know, I mean, because especially those things that Jim was saying about it, but you know, but we finally convinced him. We did a search and it read over a number of applications. And then we all voted on what we felt was reasonable. And we came to a conclusion that we would continue with Callan. So we have to vote that the contract is going to be for 5 years or 4.
I think it was clarified that 4 years with 1 year option.
Okay. So that would run to 27
Correct.
at the
With-
minimum,
With a 1 year option. Yeah.
27 plus 1. And the reason why that is, I
Yeah.
suggested that is because 3 of us and
Yeah,
our terms are in 2025. So with that, is there a motion to, Extend.
Move that we extend our contract with Callan Associates.
and this is second? All in favor? Aye. Perfect. Thank you very much.
Thank you. We look forward to working with you.
You know,
So the city handles the contract signing and all that.
motion to
Yeah,
You
we'll
didn't-
draft, I think we can do an amendment from the current contract
Yeah.
and we'll work with JITSMA to make sure that.
What about the thing about they were
Right.
supposed to wear ties?
Yeah, I think so. I thought it was black.
At least they're on time.
Yeah, yeah.
Yeah, with black ties. Black ties.
All right, next, LSV.
Hi, everyone. Sorry for being late. It's a mess out there. Had a pilot delays and, well, there's traffic, so sorry, no excuses, but I'm late. I'm sorry about that. I have books. Should I pass these out? Well, I see one here, but I've got
Mine's an old one.
3 copies. If you've got some on the computer. Okay. You good? You have it? Okay. Okay.
Thank you.
So it's nice to see you all again. I know the last meeting or 2 has been virtual and I've been here several times before COVID, so it's been a little while, but nice to be with you all. I think we celebrated our 20th anniversary in March. So we're grateful for that long relationship we have with you. It's certainly been rocky like any long relationship. We are your deep value manager, and it has not been a kind environment for value stocks when you look really since the financial crisis period. I think the last couple of meetings we had, we talked about what a great opportunity it was looking ahead for value, given valuations and how well growth stocks did through that COVID period, how expensive they got. So we're sitting here playing this role in this portfolio for you, and we didn't stray from it. And everything came back very strongly in 21, 22. We were optimistic that was going to continue in 23. It did in January and February. And then you all saw the headlines about Silicon Valley Bank and all these bank concerns, which saw money kind of float right back to growth stocks and this perceived safety of these growth stocks. So I'll talk a little bit about that dynamic, talk about recent performance, outlook going forward, but I'll start just with a little bit of a very brief organizational update first. Get my glasses out here. So in terms of the organization,
You don't need too much.
yeah, very brief.
You know,
I do want to tell you, because never really in the history of LSV do we have, we have employee turnover. But we did send a note out a few weeks ago that if you flip to page 7, our Director of Research, Bhaskar Swaminathan, who's been with us for almost 18 years, is going to transition to a academic advisor role. He's our Director of Research. Swami was a professor at Cornell prior to joining LSV. He just turned 60. He's going to be going back to India in September. His father passed away recently. His mom's been ill, so he's going to be indefinitely back in India and taking a lesser role. So did just want to make sure I communicated that, because again, the org chart is the same really over the last 10 years, with exception of the addition of a few people. Other than that, everything's stable in terms of assets, the team, no changes to ownership. Happy to answer any questions if you have any on the organization. Otherwise, it's stable and the news is good.
Who will be taking over for him and his various roles?
Good question. So, when Swami joined almost 18 years ago, it was really Joseph and Han Q and then Swami doing research. So we've added many people. It's a bigger team doing research, so we're not going to replace that title will not exist anymore, Director of Research. We are always opportunistically looking at new resources to add, and I think we'll probably have a couple new hires, not to replace him, but on the research front. Someone with an accounting focus, I think we're looking at. So a couple new hires we'll probably have before the end of the year. Okay, good. Let's flip to page 11. Sorry,
I
please.
got a question.
Yes.
Your investment team, it seems like, is everybody, University of Chicago, University of Illinois, University of Chicago, University of Chicago, University of Illinois, University of Chicago, University of Northwestern.
Yes, we are Chicago focused. So the founders, two of our founders, one was a professor at University of Chicago Business School. The other was a professor at University of Illinois. We're all based in Chicago. We're 42 people based in Chicago. So obviously, when we recruit, Chicago and Northwestern are great.
Where are you
pools of talent.
located?
I'm in Chicago.
Oh,
Yeah, we're all in Chicago, the whole team. So yeah, obviously Chicago, those two universities are great sources of talent for us. Not that everyone comes from there, but when we do hire new roles, it's an easy
I
place
was
to start.
just curious.
Yep.
You got Loyola too.
That's right, Dave Beata. Played good basketball a couple years ago.
Yeah.
So page 11, we manage a small cap value portfolio for you. As I said, going back a little over 20 years now, it's benchmarked to the Russell 2000 value. I always like when we have these long relationships, just showing the power of compounding. When you funded back in 03, 10 million, you've taken out 80% of that over time, but it's grown 18 million. It's a 9% return annualized. Shows the power of compounding when you stick with an investment and stick to it over time. There's certainly benefits to that. So page 12 are the portfolio characteristics as of May 31st. So I mentioned this word deep value, that this role we play in your overall portfolio. And by deep, it means that the portfolio trades at deep discounts or big discounts relative to the value index, and certainly relative to the core index. So you can see on valuation metrics like price to earnings, price to cash flow, we have big discounts relative to the value index. So we are not overlapping with any core or growth exposure you have. And very important to emphasize that these are high quality companies we invest in. It's very easy for us to get a cheap portfolio and buy the Radio Shacks of the world and, companies that are probably cheap for good reason. A very important component of what we do is to focus on companies that have cash flows. These are companies that generate earnings. Book is much less of a variable for us. And you can see actually the book price to book is about the same as the value index. So we like companies that have been out of favor recently. Maybe sales growth has been slowing a little bit. Investors are starting to get a little pessimistic about future growth rates, but they're still generating cash. They're paying dividends. They're buying shares back from the market. We don't like companies that are issuing debt, that have big capital expenditures. So I think very important to note that you're getting this deep value exposure, but we're not compromising quality here. These are quality companies, and it's very diversified. We own about 200 stocks in the portfolio, so we're not taking concentrated bets. It pays off in a period, not that we did not own Silicon Valley Bank or First Republic Bank, but in early March when those names blew up, if you're a 30 stock portfolio and you love those names, it's pretty hard to recover from that. So we've always had this belief that diversification is a prudent way to manage the money. Where we're very different is that valuation bet. So you can see we're trading at 50% on a price to earnings basis compared to the value index.
Do you, if they have debt, do you have a level that you don't have, you don't invest in a company, say that's BBB or anything like that? Do you have a ratings?
It's not that clear, but I mean, it gets some weight. So we generally don't like companies that have debt. But if they look very attractive on a lot of the other metrics, that depends on the level of debt. So it's somewhat dependent on other variables. But we tend to, obviously like companies that they're generating cash, they're paying down debt, giving money back to shareholders and not carrying high levels of debt.
With 207 holdings, what's the average number of holdings per PM?
So we have a quantitative model. Good question. I should have mentioned that. So we have a quantitative model that we use, and all the inputs comes from research, years of research and back testing. We have an academic foundation. Our founders come from academia. So it's the same team, same process that we use for US small cap, emerging markets, large cap. So we don't have analysts covering stocks. We don't go tour factories and meet with company leadership, but we rank every stock in the universe using this model.
Okay.
But it's important. It's a good question because it's important to note that it's not a black box, computer thing. Our average holding period is 4 to 5 years.
Right.
So it's not a high frequency, trading approach. So there's some human overlay on the back end. When we look to buy stocks in the top 15% of overall rankings, we sell when they fall out of the top 40%. But the portfolio management team, which is about 5 people, will get together and talk about that, before executing.
Early AI.
Yeah, no, very much that we've been getting a lot of those questions obviously lately. And I think what we've done is we're trying to, we think the machine, this algorithm we have helps us avoid behavioral mistakes that we're trying to exploit, right? I think it's tough if you're sitting around a table like this. Well, what do we do with the banking sector now? Should we buy more? Should we trim? Hard to get those decisions right. By relying on our model, it allows us to be very clinical and systematic and consistent in what we do.
So how does the model, because financials would probably look really good, right? Because it's been so out of favor, but the dynamics of that industry have changed. And that's not necessarily something that factors can pick up, because, right? Like, so how do you?
Yeah, true. I mean, macro factors or anything kind of driving the market it's difficult for our model to pick up for that. And that's where I think the diversification helps. So we are overweight financials, the model likes financials. We were slightly overweight, and by slightly, I think the benchmark exposure to regional banks was about 15% of the value index, and we had like a 60 basis point overweight. The model like them, but we're limiting that risk. So that's one way that we kind of minimize that impact.
Does the index give you guidance in terms of sector acquisitions and sector holdings?
So we do optimize to the benchmark. So if you flip back to page, all the way on page 18, we have I'm colorblind, so I never know the correct colors of these, but the top bar is the portfolio exposure. The middle is the Russell 2000 value. We put the core index there, the Russell 2000, just for reference. So we're optimizing to that value index, and we won't have more than plus or minus 5%
Around the
relative to the
index,
sector.
so
Exactly.
you are following the index.
Exactly. So we let the model guide us to where it finds attractive opportunities, but if it loves a sector, we'll limit the overweight to 5%. A sector like real estate where we don't like it, we'll minimize the bet to, no more than a 5% underweight. So it is taking some sector and industry bets, but they're small. Back to that characteristics page, where if we have a risk budget that we're spending, it's really in that fishing in that cheaper pond is where we have conviction. So looking at page 13, a couple things I want to point out here. These are index returns as of May 31st. First is just the difference between recent performance of large cap growth stocks in the US and small cap value. You've probably seen some of this if you've had your large cap managers in, but take a look at the 1 year column. The top shows the large cap indices. Look at the large cap growth index. The trailing 1 year return is 9.5%. And if you go down a bit to the small cap value index, the Russell 2000 value, it's down 11.5. So you've had a 20% spread over the last year between how these large cap growth, which really is driven by, the 4 or 5 biggest stocks that you're hearing about, NVIDIA and the usual FANG type suspects. And it's about 25% year to date so far, just in the first 5 months. But if you look 3 years, it's pretty flat. And I'm going to get to that in a moment, but we had this really good bounce back for small stocks, for value stocks in 21 and 22. But if you go back out further, 5 years, the spread is like 11%, and it's 8% over 10 years. And there's really no reason that those should be that different. So I think the point here, and I'm going to make it in a couple other ways on some other slides, is that small and particularly small value has been very out of favor. And looking at these spreads, you would think at some point it narrows, and that would be good for value and good for small
Well,
cap.
ridiculously low interest rates is a large part of
Yes.
that, right, over 10 years.
Very much so, for sure. And it was continuing that way, and then this banking concerns and concerns about where rates are going, suddenly now flight to safety back into these big names. But I've got some interesting slides in the back to show you too on that topic. And then the other thing here on this chart is the value versus growth spread, just generally within small cap. So year to date, you can see it's minus 9.9%, meaning values like growth by 10%, 14% over the trailing year. It's positive 9 over the last 3 years, which is really about the time when the vaccines were announced and value came back, but still negative for 5 and 10 years. So again, small value been very out of favor.
I have a question. Do you think we're gonna have a recession? And if a recession comes and rates go down, wouldn't that be negative for the banks?
So I don't know. I mean, we don't have any kind of macro opinions on those things. We don't incorporate that into our model. Obviously, most experts have been calling for a recession for some time. It hasn't happened. It still seems somewhat inevitable at some point, you would think. Maybe that's not great for small cap stocks in theory. But I think given how expensive the large cap stocks are, they're just so priced for this amazing growth that they couldn't achieve in a normal environment. That in theory, small stocks would likely hold up better, and particularly value relative to growth, given how spreads are. But for financials, yeah, that's possible. The banks, obviously lower rates maybe hurts them a little bit. And that's why we spread out some of those bets. There's a lot of, within financials, there's many sub-industries. The banks are just one component of it. So performance is on page 14. We've got a lot of numbers here since it goes back 20 years, but if we start with the calendar year summary, just want to focus first on this 2017, 18, and 19 period where we really struggled relative to the value index. Growth, as I said, had been doing well for quite some time. Kind of going into 2020, growth looked very expensive, value looked very cheap. We talked with you about that, I'm sure. That the opportunity looked good, and then we have a global pandemic, and everything goes into growth, and value gets crushed in 2020. 2020 was the worst year in our 28-year history on a relative basis. Tough year for value. So coming out of that, spreads were even wider, more attractive for value. You can see in 2021, the portfolio rebounded strongly. It was up 37.5. The value index was up 28, so we were close to 10% ahead of value and 23% ahead of the core index. So these things can reverse quickly. 2022, unfortunately, was a down market, but we gained another 10% on the value index and 16% ahead of the core index. Again, optimistic that was going to continue because it was still very historically wide in terms of the spreads. And then March kind of derailed that. So our expectation is that over the next few years, given how attractive these stocks look relative to the more expensive stocks, and you can see on that characteristics page how big the discount is, it's a good time to have exposure here. Of course, things, these roller coaster rides are inevitable, and it's disappointing to see it this year, but we like how the portfolio is positioned, certainly to have more years like we did recently in 21 and 22. 16, I think, is a little of my defense of this. So 16 shows relative valuations of value versus growth in the small cap US market. So the red line, let's start with that, is the forward price to earnings ratio of the small cap growth index relative to the core index. So essentially what that's showing is that growth is very expensive relative to core compared to history. In that box, you can see the historical average is 23% premium to core. Growth always trades at a premium because there's higher growth expectations. Historically, that premium is 23%. Currently, it's 63%. So that tells you that growth is, we've never seen it this expensive relative to core. And that really started back in that 2018 period. You can see it was, trading at about the historical average in 2018. Just gone straight up. We had the drop off here and then the recent kind of tick back up. The blue line is the forward PE of the value index relative to core. So currently it's trading at a 30% discount. The historical average is 14%. So it's not as cheap as growth is expensive relative to core, but it's still cheaper relative to history. Big spread there. So I think that's one data point that we suggest to look at and say, hey, this is not going to remain this wide forever. At some point, there's some reversion to the mean here, and it's going to be harder period for growth and better for value.
So this is all small cap stocks?
This is all small cap in the US, correct?
Some of the factors are like probably momentum, right? I think they fall into like a momentum bucket. Is that fair?
Like the growth stocks?
The factors themselves.
Oh, the factors, our factors.
Yeah.
So our factors are really, because our holding period's pretty, looking out 3 to 4 years.
Yeah.
Most of the weight in our model goes to the valuation block. So call it 80%, 20%. We want to see recent signs of momentum, 3, 6, 9, 12 months. But really the momentum helps us avoid value traps. So a company that is cheap and performing poorly, we think we're buying it at an attractive price, but it's going to go down more. So we want to see some positive signs, catalyst before we look to buy those.
Okay.
So yeah, momentum, like Meta is a good example where in our large cap, we actually started buying it because it had gotten so cheap. But it wasn't before we started to see some momentum back.
Right.
It was a stock that could have certainly gone down a lot more.
Right.
But I think your question is a good one because you would assume that these large cap, mega cap stocks are what's driving that.
Yeah.
But this is just small cap. So it's not NVIDIA and, Google and Alphabet and, Netflix driving that. It's these are small cap stocks only. Be conscious of time here. So I do want to, on that note, maybe go back to a couple of these supplemental slides. So slide 22, I think is a really interesting one. As the title says, and Greenspan coined this term years ago, the irrational exuberance. This is a chart that's tracking the weight of the top 10 stocks in the US over time. So slide 22. So the blue line there is the weight of the top 10 stocks in essentially the S&P 500. So currently it's 31.5% weight, the top 10 stocks. You can see historically the median is about 21%. We were at 25.3% at the height of the technology bubble in March of 2000, which many think back to that being the greatest period for growth, which ended up being the greatest time to probably put some money in value, given how the market performed after that. But we're well outside that weight right now. So we've really never seen top 10 have such a big weight in the index. If you go to the next slide, this shows the relative valuation of those top 10 stocks versus the bottom 490 in the US over time. So the dotted line shows the historical average, which is that they trade on par with each other, as they should. Why should the top 10 be any more expensive than the rest of the 490 over time? Almost 1.0 there. Currently, we're at a ratio of 1.8, meaning that we've never seen the top 10 stocks be this expensive relative to the other 490 stocks. So not only is the top 10 very concentrated, they're also historically expensive. And you can see that line, it did come down a lot over 21 and 22. It's kind of nearing the average, and then it just spiked right back up here over these last few months.
Do your research types, and they're like macro research guys, I guess, or what, what's their-
We don't have, we don't incorporate macro factors in research. I mean, we have opinions on things maybe where they're going, and might be different for team members, but we find it's difficult to get those calls right. So we don't have factors like that in the model. We're fully invested.
I guess what I'm wondering, looking at these charts, is some of what's going on here the fact that technology is becoming a bigger and bigger piece of the economy, and also big tech, the really big mega tech companies are really the ones benefiting from that the most, because their economies of scale, their
Sure.
expertise, their hiring, all that stuff.
Yeah.
I mean, could that be good? I guess it gives me a little word of caution about reverting to means, because the means, the old means might not mean anything.
No, it's a good
I don't
point.
know.
I think that's a great point. It's kind of a philosophical discussion of, are things different this time? And
Yeah.
there are a lot of people making that argument. Kathy, Wood from ARC, right?
Mhm.
That we're in this new paradigm. People were saying that, of course, back
She's
in
been wrong a few times.
99. Yeah.
Yeah.
Right.
Yeah.
Back in 99, 2000, I remember I lived in San Francisco in the Bay Area, and it was the new economy, and earnings didn't matter anymore. It was all
Right.
about clicks and eyeballs. And so, there's some parallels to that
Mhm.
today. I think that, hey, we're in this new, things are different now. And, no doubt these are incredible companies.
Right.
It's just, are they good investments? If you do a back of the envelope calculation of how NVIDIA, for example, has to grow to justify its valuation, it doesn't even make sense. You can't get to a growth rate that justifies it. So that's where I think where we titled this slide Irrational Exuberance.
Mhm.
No doubt these are incredible companies. No doubt they have incredible moats of competition that in a lot of ways have justified the growth they've experienced up till today.
Mhm.
But the price to earnings ratio, price to cash flow ratio they're trading at is forward looking, and it's
Yeah.
factoring in future growth rates. And there's just no way they can grow at the rates, they would become the economy eventually, right? So,
But the thing is that I agree with you. I mean, I started working for US Steel when I got out of college, and the steel companies
How'd
and
that work
the
out?
auto companies were like, and as they lagged, everybody said, well, they could revert the mean instead,
Then I went to Japan.
yeah, I mean, so I don't necessarily, I'm not saying that they're bad investments. I'm just saying I don't believe in the reversion to the mean. It's like,
In all cases.
do, right,
Yeah, not in all cases, obviously.
right.
yeah, historically it's been there, no doubt, but you're right, over the last, really since the financial crisis, we haven't seen it. Historically, value has outperformed growth stocks. And the reasons our founders kind of argued was behavioral reasons, that
Mhm.
investors tend to extrapolate what's happened in the past too far into the future. They get overconfident on their ability to forecast future growth rates. It's psychologically difficult to stay with stocks that are underperforming,
The
these
rebounds.
boring companies. So they get kind of underappreciated. And conversely, people get too excited about, the trend of the day, right? And the expectations are too high. So the theory has always been that they revert to mean. And so, but that has not been the case. You're right, in the last 10 to 12
Even
years.
like banks, I think the number of banks in the United States has declined by over 5,000
Mhm.
in the last 10 years. So all these small banks, the money flows didn't go from one small bank to another small bank. Small banks all lost deposits to the large banks. Right.
And or got acquired, yeah.
Yeah, or.
Yeah, there's
If they
definitely
get
some
acquired, that could help. but, you know.
acquisition activity.
Yeah.
So what is it, the large cap model, like what is the relative weighting in your large cap model for these top couple of names, Apple, NVIDIA, et cetera?
Oh, we're significantly underweight.
Yeah.
Yeah, I mean, we have very little exposure. We own a little bit of Meta, as I said. I think there is Johnson and Johnson's in that top 10, which we own. But I think we have one or two holdings in the top 10. So
Wow.
we are significantly underweight those stocks for sure. Like tracking errors, gone up because of that. But kind of just to finish the thought I have there, I mean, it's an interesting discussion, and I'm not sure we have great answers to that. Value has not performed well relative to growth when you look over the last 10 years, and some say that things are different this time. But I think Joseph Lakonishak, our founder, the team has done a lot of research to try to understand that in a lot of deep ways, and always come back to the fact that the valuations do matter and cash flows matter. And
Earnings matter,
You know,
paying down debt matters.
yeah, and some of these companies, that are so cheap trading at 7-8 times earnings, they're not going to grow like these growth companies, of course. But if expectations are for them to grow 3% a year and they grow 5%, they're paying dividends, you get some multiple expansion, you're looking at an easy 8 to 10% return just
Yep.
there. It's pretty minuscule kind of what they have to do to surprise, to kind of provide an excess return. And Joseph, if he was here, would say he's never seen the opportunity to look this good for the types of stocks we hold. But we've been saying that for 5 years,
Yeah.
right? So, I mean, I'm not sitting here saying like, pounding the table. I think we would say if you have an overall portfolio, you should, a smart decision would be to slightly tactically overweight value right now relative to growth. Not because, again, value is a sure thing, but because the growth is just hard to justify.
So,
By the way, you were here June 13th, 2018. I saw your thing, so
Oh.
when you said 5 years.
Oh, I saw that book. I was like,
now we're good.
numbers were good then.
Frank
So I
is
wanted
back.
to show performances of that.
What about
That's great.
your fund flows in this fund? Are you getting redemptions? Are you getting money in?
So, yeah, firm-wide assets are 92, and, we've peaked at maybe a little over 100. Markets have been down. We have a lot of defined benefit plans that are de-risking. So we have kind of a steady flow given the number of clients. We have 350 clients of money with outflows, but I would say we've seen more interest in value than we did 18 months ago, for sure. Not in a big way, but we just, state of Mississippi just hired us for $1 billion global equity mandate. Small cap, we recently reopened that for very limited capacity. It's been closed for a long time. And when we have some outflows, we've been able to fill that real quick. But 3.2 billion, we wouldn't look to, it'd be less than 500 million. We'd probably look to close that back. So it's been stable. I would say where we've lost assets, it's definitely not us getting replaced by another value manager. It's going passive or getting out of equities, these plans that are de-risking. Those are some of the challenges we face.
So Silicon Valley would have been too big for this portfolio, I presume.
No, it's just,
Were you in there?
we didn't own it. We could have,
Yeah.
but maybe a little bit of luck there, but we have a variable in our model that's related to short interest.
That's
And
exactly what
with-
you're gonna ask.
When we see high levels of short interest,
Right.
that's kind of
Well,
a
and
red
also,
flag for us.
does your model since you got 27% in financials, does your model get data on credit, on interest rate risk in on the balance sheet? of the
No,
bank?
so that was, so we've been really looking at that. And, obviously that was the first kind of thing the team really started to look at, because that was just not a
Yeah.
consideration
Big
before.
red flag, but nobody saw it, right?
Right.
Yeah.
I mean, obviously the board of Silicon Valley Bank, it's amazing that just on a one-off that they weren't thinking about that.
Mhm.
But for us, Silicon Valley Bank was very expensive. The short interest was high. So yeah, the team's really been kind of reevaluating. Non-performing loans was kind of the main thing we would look at as risks.
Mhm.
What's the level of non-performing loans? So there were other risk factors too. But obviously, given how rates went up so quickly, that became a new consideration. So
Yeah.
we've,
Kind of new in the last, 30, 40 years, right?
Yeah.
That fast acceleration.
so
right?
Zion is one bank we own in our portfolio that's, had some
Mhm.
concerns. We still own that. But the rest of it, we feel good about. So want to be conscious of time. Maybe I'll pause there and see if you have any other questions. Kind of quickly went through some of the material, but
You traveled all the way from Chicago. You want to take more time for that?
that's kind of you, but I think maybe let's see. a couple more slides.
Cocktails or go to the bar. This is-
Maybe the last slide to take a look at is 17. So I've kind of talked about how value is cheap relative to growth. This top line chart shows the valuation spread of the portfolio relative to the value index.
Page?
17
17.
over time. So that's a forward PE, the blue line relative to the value index. And you can see that the portfolio always trades at about a 37% discount over time in periods like the financial crisis, which I think you have to kind of throw that out because earnings were not really relevant. So I would remove that maybe a little bit, but we're a little bit above median. So the portfolio is trading at even a bigger discount than it normally does. And I think some of that is due to the fact the way Russell rebalances their index. So what they do is they put 50% of the weight to growth, 50% to value. And when growth has had a good run, you really see this in the large cap indices. They're kind of jamming more expensive companies into the value index to keep that 50-50. So the value index is even a little bit more expensive than it is historically because of the way Russell does that. So I think that's also a case for not being passive right now, that I would say for active managers on the growth side, they've probably struggled because if you didn't own those big stocks, which most weren't overweight, it's been tough, but I would think it'd be good going forward. And then on the value side, given how the index has gotten a little more expensive, there's a lot of good opportunities relative to the value index right now.
So what do you do? Just an extra trade when that comes around? Like in terms of the Russell rebalance, you just have to quickly try to.
It depends. Usually it's pretty small, the changes they made. Like in large cap, it can be bigger. So Facebook, Meta is going out of the value index. It was in the value index last year.
Yeah.
And it's, I think, like 170 basis points, and they're removing it. It's going back into growth. So that's one where now that we have some exposure, we trim. So we pay attention to it, but mostly it's on the margin. It might cause a little rebalancing, but nothing significant.
How are they rebalancing the index?
They do it every June
Yeah.
30th. So it's about to happen. And they've kind of already signaled. So you're basically already know what's going to happen. They give you like 8 weeks in advance, they give you a little bit of a signal, and then it gets a little more clear.
Mhm.
So you can anticipate it.
Do you have to own stocks that are in the value?
No, good
Okay.
question. So if it's not as much of a consideration in small cap because the weights are small, but if a stock is 5% of the benchmark and we don't like it, we won't own it.
Right.
Yeah, but we do have limits on the overweight that we can have, generally about a 1.5% overweight, smaller in small cap, maybe 1.2. So we're not taking a big bet.
Yeah, you don't have even 2% in any stocks, right?
Right, correct. Yeah, obviously there's small weights in the index in the small cap space. So in some ways, I think some of these stocks, I mean, these aren't micro cap stocks, but the weighted median market cap is less than 3 billion. We're kind of scratching our heads with all the private equity money floating around right now, but they're not acquiring some of these small cap companies that are cheap and have cash. Often a lot of the alpha we get in the strategy is from that acquisitions. We're surprised we're not seeing more of it. Maybe we will see a
Because
little
of
bit more of
rates, you
it.
think?
Um,
Some of the debt finance?
Yeah, that's probably a good thought. It is a little surprising to us, but there's apparently like $1 trillion of private equity money kind of sitting there waiting to be invested. So maybe it'll start happening.
Mhm.
But that would be good for this portfolio for sure.
Yeah, I guess it's a function of your model and how you do it, but it's like it seems like a lot of holdings, for a portfolio.
207?
Yeah.
It's a lot of small bets.
Yeah. Yeah.
And then, again, I think if you hear that 200 and you think, oh, they're not taking big sector weights industries, is that kind of closet indexing? But you can see on the characteristics how different we are from a characteristics point of view. And obviously in the returns, when you look at the last few years, you can see tracking errors really in that value positioning. But I think the thought on that, just to finish my thought, is
Yeah.
200 names, as I said earlier, we've done a lot of studies on this where a few years ago, there was a big kind of interest in these concentrated approaches and higher conviction. It's like, well, if you get this model, you should have, it ranks every stock from 1 to 2,000. Why don't you put all the money in the top 10, 15 stocks? And the answer there is that we don't see that much of a difference in alpha between stock 15 and stock 50, when there's some, not enough to take a 5% bet, which again, you can get so burned. I mean, in the emerging markets, Russia is a great example, right? I mean, nobody saw all those companies, Lukoil, all these oil companies were so attractive and value managers loved them. They were very attractive opportunities. And then, you get this crazy guy trying to take over Ukraine and everything goes to zero. So maybe that's an extreme example, but the 200 stock approach is to minimize those risks, which we can't control. But where we're willing to take the bets is on that valuation risk.
How often do you make major, changes or upgrades to your model? And I'm sure it's like a continuous process, but there's been times when you do some big changes in it and
I
kind
would
of get
say
different answers, or
it's more at this point, it's definitely evolutionary, not revolutionary. So, finding some new signal to put in the model has become harder and harder over the years. Early on when kind of before computing power. So now it's more, improvements on the margin that might affect, 50 or 100 companies. I mean, for example, we recent enhancements we made to the models looking at auditor data. So if we see companies that have frequent changes in auditors, that tends to be a red flag. That's not going to affect every company in the universe. But we've done some extensive back testing, and I'm making the project sound way more simplistic than it is. But if there's two companies that the model likes equally, and one has that kind of red flag, it'll gravitate to that other one. All these incremental kind of improvements and changes we're making over time add up to more alpha. But in terms of the model being, focused on valuation and momentum and those weights, that's never changed over time. It's all the sub variables. We've had even more of a stronger emphasis on cash flow. That measure has become way more robust. I think a really good example to answer your question is looking at earnings. We've always looked at forecasted earnings from analysts as a variable in our model. Years ago, and by years ago, I mean 15 plus years ago, we used to just take the median forecast. It seemed like a good thing to do. With more research, we found that the pessimists tend to be more accurate than the optimists. So the cheerleaders that were kind of always rosy were right less than the pessimists. So
their own positions.
yeah, exactly. So we weighted the pessimistic forecast with more weight.
Yeah.
And then we took it an even step further after some more research when you see some bold forecasts. So an analyst is moving away from the herd, whether it's positive or negative, those tend to be more predictive. So we would give those forecasts a little bit more weight. So I think that's kind of a representative example of how the model's enhanced over time and gotten more robust. But we still, right now, we have a big project that's been going on for about a year on looking at patents, which is a very challenging project from a data perspective, because it's not like XYZ company has this patent and it's linked to a QSIP that we can tie to the stock. There's a lot of kind of machine learning type mapping to get these patents mapped to a company. And looking at it's really kind of an exercise in R&D and companies that are doing more R&D, more patents that are getting citations, and what's the kind of the future innovation of the company. So that's probably more of an example of some bigger variable that we're working on, that if it finds its way into the model, it's a bigger change. But again, it's not like suddenly all the rankings are going to change. It's going to have some
Just
impact.
curious, is a lot of your data input automated? Like what kind of sources you use? I'm just curious.
Yes,
Where are you going with artificial intelligence?
Yeah, so CompuStat, WorldScope, all the big data providers. I mean, there's many databases we use for analyst forecasts. IBIS has something different. So there's a lot of databases where we buy data. Every morning, there's one person that downloads all of that. So it's a live update in our model. It takes several hours. Runs it, gets up early, goes back to sleep, and by the time everyone comes in, it's fresh. So every day we have fresh data stock rankings. We rebalance your portfolio every 6 weeks, so it's unless there's a cash flow,
Mhm.
we're not doing anything in between, but we always have cash flows every day going on. So we have to keep the data fresh. So yeah, that's been a big job, just from the algorithms we use. We do sanity checks on that data. Sometime a simple number that you think is simple, CompuStat and WorldScope are very different. They have a different methodology, could be a data input error. So we have flags for that. That's a big part of what the team, kind of a systems development team does is, obviously if it's garbage in, it's garbage out. So making sure that data is good. We're doing a lot of machine learning projects. So trying to replicate, like, for example, predicting growth rates. Can a machine or a more complex algorithm do better than we are doing with our current model on predicting future growth rates? We haven't found much yet that's adding above and beyond what we're doing, but we're always testing these things. We have an analyst on our team who was in the Israeli military data person and another younger guy that worked at Uber data analytics that are leading a lot of these type of projects. And so we're always kind of looking for ways to improve what we do. But I would say generally Joseph's approach is to be very cautious with making enhancement. It's a high hurdle rate to change something.
Yep.
It's got to be statistically significant if you can back test it. If you can't, it has to make a lot of common sense. We have to understand it. And in that case, it's still going to be a very small weight that we would put on it. So,
Do I find it interesting that you take the more pessimistic with a higher weighting, and I agree with that. But do you have like a trigger point when you talk about short positions in a stock? Is it like there's a 5% short interest or 10%, or is there a number?
yeah, I think it's a little more than 10%. So obviously there's always some shorting going on, right? That's
Right.
just kind of an efficient market. You have that. It's much higher in growth stocks, as you can imagine.
Right.
So for value stocks, I think that's kind of where it's interesting because you generally don't see it as much. These stocks are pretty cheap. Obviously, the Radio Shacks of the world or BlackBerry, there was a lot of shorting in companies like that. But in these companies that are a little more stable, the level is not that high where it becomes a flag for us. And I think it is kind of above 10% range, but it's not. Obviously, if you get much higher than that, that's a very high number. So that was a project actually that Swami had run maybe like 15 years ago, which again, doesn't affect a lot of companies, but it's certainly had an impact over time on avoiding some stocks.
I see that it's primarily US centric, but what about the international exposure, what about the Chinese exposure? How do you assess that?
Yeah, we wouldn't own that obviously in this portfolio. This is US only,
Only
but we do have non-US strategies, and our approach in our non-US strategies is to be country neutral relative to the benchmark weight. So if China's 30% in the emerging markets index, we're about 30% because you can't predict what Xi or Putin are going to do, and it's difficult to time that. So we try to pick the most attractive stocks within each country's. So kind of a prudent approach we take in our non-US, but we would never own
Anything in
outside
that
the US in this portfolio. No. But we do have a lot of clients that are looking to understand how they could, reduce their exposure to China. Nobody that's done it yet, but a lot of people thinking about it. And I think it's obviously what happened in Russia and if China invades Taiwan and Taiwan, but I think we're gonna have bigger problems than what our portfolios are doing if that happens. So.
Yeah, we had some guys who got hooked with stocks in Russia. Remember the guy? Yeah.
Nickel.
It's good. Yeah.
Yeah, we converted to try, so that all went to zero and MSCI put it all to zero,
Right.
but you could convert to local shares, which we did for most of our clients or ones that wanted to do it. And then, so it's converting it to rubles. And that just became like an option that if Putin dies tomorrow and suddenly things go back to normal, at least there's some possibility there could be value here again. So, we're holding on for that, but it was like a 2-3% weight in the emerging market index. But again, back to concentration and your comment about 200 stocks. We know some emerging managers that loved Russia that were 10% overweight, and that's, it's death to your to your strategy.
Yep.
So you can't recover from that.
Well, your strategy, you're not buying, one particular bank, because our people here yet, last meeting owned, whatchamacallit,
San Francisco
San
Bank.
Francisco Bank. Yeah. So, your research served you well.
But like I told them, Jim Cramer was pushing Silicon Valley in February. So like 6 weeks before it blew up, really
Yeah.
great investment.
Right. Best to keep
Yeah.
that show off. I think.
Does anybody have any other questions? Do you have anything else?
Good.
That's it. Thank you. We're really grateful for the long
Yes, thank
relationship.
you.
It's nice to be here in person. with
Yep.
you all, so thank you.
2015.
2015, there you go. I was here.
I know.
I had brown hair back then.
Yeah.
Something happened.
Or
during
you have a
COVID.
room at your house, Frank, where you keep all these things?
Hey, when I leave and somebody else takes over,
Yeah,
I'll tell you.
Yeah, great to see you again. Different uniform, but
I
same
know,
face.
that's right.
Nice to see you. Safe travels.
Yeah.
Sorry again for being a little bit late.
No,
No
no
problem
No,
at
there
all.
was
Thank
lots of
you.
traffic.
You flying back tonight or?
Tomorrow, I have a good friend that lives in Westport. We're gonna have dinner. So
Okay.
that he's
Oh,
not
nice.
sure. So, yeah, we're going well.
Good.
Thank you. Good to be
Thank
with you
you.
all. All right, take care.
Oh, you can get the money, it just goes to sleep.
Thank you.
They can still see us, it's just that
Yeah.
it turns it off.
The LSV is for 4.7%, 4.8% of our portfolio.
Yes.
What's the argument for increasing that or decreasing that, based upon what we've heard?
Well, I think strategically, you have principal dynamic, which is your mid growth manager.
Okay.
So the idea is that you're passive in large cap, because I think, as we know, active management in large cap has been extremely difficult to beat the benchmark. And the idea is active growth in small cap and active value in small cap complement each other, where there is proof that active managers can outperform the benchmark. So the idea would be for them to be equal weighted, so you didn't have a value tilt or a growth tilt, so that you're not making a style bet, intended or unintended in the portfolio.
We did take money out of, a couple of years ago, didn't we? Or whatever?
From LSV,
Yeah. How long ago was that?
it was a while ago. And if you look at the current allocations between LSV and principal, they're very close to
Yeah,
each
they're
other.
both the same.
And I think the other complementary factors are that we heard, they have a systematic model, and principal is really a bottom-up fundamental based philosophy. And those two philosophies are very different. And they're targeting different parts of the market, but they do complement each other in terms of what they're looking at with companies that they own.
Anybody have anything about LSV they want to just keep our money there? It's
Yep.
fine.
Yeah.
All right.
Good.
So we're gonna move on to performance.
Sure. I know we have the big books. We're going to focus on April performance, if that's okay with everyone.
Yep.
Great. I don't know where.
It's tab 3.
Tab 3.
Yeah. 1 and 2 are the quarterly.
You want to provide a quick?
Yeah,
background?
yeah, just real quick, kind of overview, macro level. We did see risk assets trade higher again in April. We had some positive economic data, as well as some better than expected earnings come out during the month. Here in the US, we saw the economy expand at an annualized rate of 2.2% in the first quarter, as an increase in consumption and government spending offset decline in inventories. We also saw inflation levels moderate. So when you look at headline PCE, which is personal consumption expenditures, those increased 0.1% over March. And core PCE, which excludes food and energy, rose 0.3%. And, thinking about the labor market, while it does remain pretty robust, job openings and labor turnover, there's a whole survey done for that, which is called JOLTS. That did show some sign of coolings, and that we saw that for the first time that in 3 consecutive months, It came down to 9.6 million in March, which is the lowest level since April of 21. So all of that equated to, at least on the equity side, an S&P 500 gain of 1.6% for the month. And that was really bolstered again by kind of better than expected earnings, as well as continued outperformance by the mega cap tech names, which we've talked about a lot. Of the 269 companies, this is interesting, within the S&P, over 70% of the companies posted a positive revenue surprise, while approximately 80% of the companies recorded a positive earnings surprise. Do you have,
Oh, has there ever been a quarter that there were more surprises than not? Yeah,
that's
I
really
mean,
good
that,
point.
you know, I,
Don't be surprised by the surprises. Is that kind of,
Yeah.
yeah, totally fair. But again, the largest 5 companies, those were roughly half of the index return for the month. So outside of the US, MSCI EAFE continued to be pretty strong. It outperformed. It had gains of 2.8%. Again, some of that is being supported by the weaker US dollar. And then on the fixed income side, Treasury curve shifted slightly lower with the 2 and the 10-year yields down 1 and 5 basis points respectively. And we saw higher carry assets outperform with rates and spreads relatively flat. So as a result of that, the US high yield corporate index was up about 1% last month.
I think just one comment on non-US stocks, similar to the US stocks where we've seen growth outperform value. We've seen that as well in non-US. And then within emerging markets, China, which is about 30% of the index, was down about 5% for the month of April, which you'll see come through in some of the performance. Any questions before we go through the April flash report? Okay. So I'll turn to page 3, just showing the asset allocation as of April 30th.
oh, you know, one thing I was gonna ask, from Blackstone, we got roughly $5 million, right?
Correct.
The cash is 2.2 million.
So some of that went to pay benefits.
Right, but shouldn't it first go in?
I think it does. This is kind of
Okay.
the end of the month
right.
snapshot.
Okay.
So what you're saying is it all does go into cash?
Yeah, I just want to
but
make
by
sure it all
the-
goes into cash and then it pays out.
That's exactly how it works.
Because one of the things is, as a result, if it shows a net new investment being a negative when it was really like not our investment policy, it was this city's payments.
Right. And that it is a snapshot and it is the total for the month, the sum. So to your point, it's not
End of month to end of month.
exactly.
So net new investments, that's a combination of any payments made or any additional money being put into the fund
And fees for
Right.
investment management.
and fees.
Yep,
Yeah.
so you'll see in the net new investment column, the Blackstone distribution of 4.9 million, that's
Yeah.
part of the liquidation. You'll receive a similar payment at the end of July. And then there's a small holdback due to their audit process. And I believe you'll get that in about 6 months after July, once the audit's complete. If you look up under Silchester, that 37,000, that's a management fee coming out of that portfolio. And then the negative 2.8 million in total, that's to pay benefit payments. So taking everything that occurred, whether it's investment management fees, distributions from investment managers, or contributions, that's how much went out in total for the month.
And the way we see contributions, is that cash account going up?
It did, so it did go up. That was largely went up net because of the Blackstone distribution of 4.9 million.
Yeah,
So net of benefit payments and all the fees, cash increased by about 2.2 million.
And part of that's to cover benefit payments for
Yep.
the next 2 months.
Exactly.
And
Exactly.
so that's good for June or May and June. Chitsmay does not need any more money, right? Or have you talked to
So
her?
I have, and we do have a proposal and we'll run through it as soon as we're done performance.
Okay, thank you.
Great. So just a few items in the asset allocation I'd highlight remains underweight to total equity, slightly underweight to US equity, and global equity long short, where we're liquidating Blackstone, so that will continue to come down, and ABS will be the standalone global equity long short manager once that's complete. Slight overweight to absolute return with UBS, largely driven by their good performance last year when public markets in both equities and fixed income were down. And PIMCO is overweight, but we did submit a redemption last month, so you'll see that coming through in a future flash report.
I do think though that when we had a meeting, as far as long and short, I thought concluded that we're not gonna try to get to 8%.
Right, and I think
So-
the one thing that we should revisit in the fall is whether we want to reduce that target to 4%, given that ABS will be the only manager left, and where to redistribute that extra 4%. On the next page, we show performance. I'll focus on the fiscal year to date. We did add a last month column because Walter Scott is a new manager, and this was the first full month of performance. As Scott talked about, value has been difficult this year, but you can see fiscal year to date, they're still outperforming by about 5 percentage points. And over longer term, 1, 3, and 5 year periods, LSV has done very well after struggling for a number of years. We heard from Principal last month. They underperformed for the month and fiscal year to date, largely due to their stock selection in healthcare as well as tech. Moving down, Silchester continues to perform reasonably well. This more value-oriented approach has been out of favor broadly in this high growth market that we've seen. And Walter Scott underperformed for the month. They did significantly outperform in May. So we'll see that coming through next month. And BlackRock, I mentioned China in my comment on emerging markets, underperformed for the month. Their performance has slightly outperformed their benchmark over fiscal years to date in the trailing year. And a lot of that underperformance is attributable to some things going on in China. I will move ahead to the next page. The private equity performance has lagged. And as soon as we get new marks, that will be updated. Within fixed income,
One thing, private equity, because, almost all of it is in this select 2014,
right.
but it doesn't show anything for like last 3 years or 5 years.
It's because it's a flash report. So in our quarterly reports, which are also included in the binder, we do have all of the quarterly returns. That is kind of lumped into the total private equity number up top, which even for the 1 year, 3 years, 5 years, it's still largely the 2014 fund. But we can highlight in the quarterly report the performance of each vintage.
So that's like 9 years old now. Are they starting to unwind with the
Well,
market holding them back?
no,
No,
the 2014 fund, it is making distributions.
Okay.
There haven't been capital calls in a few years. But the other funds are very old.
Yeah.
Like early 2003, 2004, 2005, and are continuing to get extensions to try and capitalize the remaining investments in those funds, but they are tiny. And one thing we could look at doing, given that combined the other 5 vintages make up maybe 30 basis points
Yeah.
of the total fund, maybe we can look to kind of streamline the performance reporting, given that those funds continue to look to sell their remaining investments and
No, I wasn't worried about the reporting. I was just wondering about.
No, your question is right. The exit strategies are not there right now. The IPO
Yeah.
market is essentially dried
Yeah,
up, right? And valuations are iffy where you don't have. a
2
lot
or
of-
3 years to their horizons, I guess. right?
Yeah. And if you can see on the page 125, it's in section 1. It's got the breakout for that select 2014, the different,
Yeah, okay.
yeah.
Ways to go.
Yep.
Yeah, it was quite a, I don't remember, we were not big on private equity.
Yeah, I wasn't here when you got
Yeah,
into it, so
we
I think
did
I assume our expectation was.
Well, the
8, 9
returns,
years.
you know,
Return's been
the
fine.
returns are very healthy, right? I mean, that's, you're getting an illiquidity premium.
Yeah, I
So-
think the 5-year total private equity composite up 16.5%,
Mhm.
Russell 3000 up 10.6.
So whether you
Like,
might not, be-
That's that R&R they talk about, and the other thing is, there's no liquidity, and when we were sitting there, they're going on within 5 to 7 years, and there's a fund that we've had for 20 years.
And if we have a recession, it's gonna be longer.
Yeah, and there's gonna be, if we wanted to get rid of all these older funds, we're gonna take a haircut of probably 30 or 40%.
Yes,
So,
because they'll have to sell them in the secondary.
right,
So,
But at this point, the return you've generated from them, I think there are a couple of them were not very good performers.
right.
But it's really, at this point, it's not gonna change anything and you've seeked what return you can get out of these portfolios and they need to come to. a close.
These would be the new Zeisingers.
Yeah, I think they are.
A lot of money for that.
Oh, we did well by, I know.
So just to wrap up performance, some of your diversifiers, UBS has done very well fiscal year to date and over longer terms, really seeking to provide a positive return in any market environment. And they certainly did that last year. And your kind of more inflation protection, inflation sensitive PIMCO All Asset Fund continues to do well, up about 4% over the benchmark fiscal year to date. So fiscal year to date, we had one of the worst years on record for fixed income in the public markets last year and public equities. But we have seen since the fourth quarter a pretty strong rebound and, the total funds up 7.2% through April, well above the discount rate. And hopefully May was more of a mixed month, but longer term, returns continue to be positive and managers are performing largely within expectations.
We're going to 6.5.
Is that the plan?
I think so, isn't it? We're
Should
going
we
and then we
reach out,
stop at
should we reach out to Henry? to
we should
confirm?
reach out to Henry because that's, my understanding is the fiscal year starts coming up.
July fiscal year.
Yeah, July 1st.
July 1, yeah.
So,
I'll copy you on that, just to make sure.
thank you.
just to add more color on the PE, so that vintage or that fund, excuse me. I mean, you invested 10.3 million back in 15. You received 16.3, or excuse me, it's appreciated 16.3 million. You've gotten back 4.5 in income. So you have an ending period market value of 21.5. So I mean, it's pretty substantial
Mhm.
return. Again, you're getting it, you are getting, you have seen it, and they always tell you this, like a premium for that illiquidity.
Yeah. no, I get it.
Right, above and beyond. So it's been a pretty healthy investment.
Well,
But the tail can take a long time.
Right.
Right.
That's why we did it in the first place.
Yeah.
Great. Any other questions? We look at the rebalance proposal. So we did talk to Chits May about how much money she needed to get to September, assuming that we are not meeting July and August, but we certainly are happy to if it is desired. She said that needed 10 million.
She needs 10 million.
Yep, and just what, I don't know what.
It's
tab
in the last tab,
So the last tab,
tab 5. Yeah.
Does
tab
that
D.
come electronically too? or-
it did in my email. Actually, you know what? It did not.
I didn't see that.
Do you need a copy of the
Yeah,
book?
yeah.
Yeah.
that's fine.
So the city's expected to make a contribution of 17.6 million in July. In addition, we're expecting Blackstone to make a distribution of about 4.9 million
In July,
in July.
Well, is that gonna be a whole, did you say they're gonna, how much are they gonna hold back?
I think it's 2% of the total. So it might be like 300,000.
Okay. I didn't know whether it's gonna be 2% of the original investment or not.
I think it was. Let me confirm.
What's the city's number again?
17.6.
This is, yeah. And that's. But Kidston will need 10 of that.
So what we're doing here is we're suggesting leaving 5 million of the city's contribution in cash. And then when the Blackstone contribution, or excuse me, distribution hits,
Mhm.
that will be roughly another 5 million
When is that happening?
in July, at the end of July. So
Okay.
in looking at your underweights in the, what is really investable, I think you're overweight or in line with your public international equity managers. Global equity long shorts overweight. Absolute return in real assets are overweight, which really leaves US equity and domestic fixed income. I think putting the bulk of it in US equity in the BlackRock Russell 1000, which is our typical liquidity source for raising funds to pay benefit payments, will help get closer to target and adding a little bit to fixed income, given where rates are. Yields on fixed income, the outlook is much improved from years past.
Isn't that over the last 7 years, let's see, how much was it they get? Oh, wow. Let's see, just to check. Oh, yeah. Domestic fixed income over the last 5 years, 1.3%. Oh, that's good.
Your favorite, right?
That's my favorite. I'm gonna give it a mark.
What was the best
So it goes
performing asset
33.6.
class in,
34.2.
21 was the best
Exactly.
performing asset class, right? Is that right? Was that the year?
What's that?
So it's really on the margin.
It
Small.
might have been only
Yeah.
because
Everything else is.
everything else got, you know.
And we're open, I'm happy to, discuss further, see
So,
what the board thinks. And
I mean,
You're recommending putting 12 million roughly
it's a,
12.6 million,
into the Russell Index.
8.6 into the Russell 1000 and 4 million into Prudential.
And Chisholm is using
I'm sorry,
3 million.
4,000 into.
4 million
$4 million.
into potential fixed income.
Prudential fixed income.
Chisholm is using about 3 million for benefit payments in June as well, just in case you're looking at the cash and trying to. This is as of the end of April.
And that actually brings down fixed income.
I'll find it a fund of, I mean, right now, we can get 5% buying. I mean, could we just have Northern Trust buy us a year bill, paying 5% instead of giving it to
Prudential.
Prudential that, you know,
I mean, you can certainly, your cash is earning a good interest rate.
But it's
I don't-
not, yeah, again, though, that goes back to like, now you're actively
Trading.
trading.
no, we're not. What we're saying is we're gonna need cash in the future, and that future cash,
Yeah, that's not gonna sit there all that long.
right, it's not
We're
gonna,
gonna need it
we're
after.
gonna need cash comes maybe in
November,
December and February, because right now, there's a
Yeah.
drawer of over $2.5 million.
They said through September,
Right,
so by October, we're gonna need money.
we're gonna need cash again.
So it becomes part of your cash holding, or is it part of your fixed income holding?
Well, if you want to define it as fixed income, I mean, is a money market account fixed income? Yes or no?
I would say no, not in the way your
Okay,
asset
so
allocation.
if a
is set up.
3-month T-bill is considered fixed income, I don't.
Yeah, I think it's worth it. We can certainly ask Northern Trust. The point is that they're not set up to trade.
We're not trading, we're just, you know, or I don't know what their money market account, if
Well,
they're,
that's what the cash is.
what's the cash paying now, though?
I would have to look it up. I don't know. But I think looking at the flash report, fiscal year to date, it's earned over 3%.
Do they have a 5% cash option right now of some type?
So I know that based on, we looked at this in the past, and the pension, the STIF, the short-term investment fund that it's invested in is the highest yielding and the lowest cost
Yeah,
available
you're-
to the pension.
year to date, we've earned more on our cash than a 3-month T-bill. Maybe
In
not, yeah.
April, you earned 32 basis points.
310 versus
Just in one month.
272,
Well, no.
Year to
the
date.
three- Well,
fiscal year to date.
okay,
So we're talking about where to put it between now and September, and then we start drawing out from it.
Right.
After September.
I mean, 3-month bills paying over 5%,
I'd much rather do that.
right?
3 months is,
Pretty sure. You know, by 3-month bill.
I don't know that,
I don't-
one, the IPS allows it, and two, if Northern Trust could ever execute it. That would be the logistical questions that I would have before I would want to say anything. We do think that the cash fund is appropriate and reasonable for a fund like this. It's earning an interest, it's earning a yield.
Right.
And for a pension plan, it is best practice to have a cash fund and not trade individual
Right,
T-bills
we're not trying to.
or buying.
Most custodians.
What we're saying is we're gonna need cash in September, probably, and rather than.
Then
Why
we
not
would
just say
suggest
we're,
just leaving it in cash,
yeah,
which is it's invested in a sweep vehicle.
there's a return on the funds now, unlike it was in the past.
Agreed.
Right.
Yep. So if you didn't want to invest in fixed income, if
Is
you wanted
that-
to leave it
we-
in cash.
That's,
You said-
well, I don't have a problem with that.
I'm good with that.
One
what do
motion.
you say? What do
You want a motion for that, I guess, maybe?
Right.
So
Okay,
invest
again.
at
okay, I'll make a
8
motion that we're gonna get the city's contribution to Blackstone redemption. The total is gonna be 22.5 million. I recommend that we hold 10 million in cash, give 8.6 million to the Russell Index Fund,
Mm.
and the other 4 million into the cash fund.
Yep, so
That
just
has a return.
just invest 8.6 total into the Russell 1000.
That makes sense.
If the numbers work, right?
Skip the prudential fixed
8.6
income.
Yeah, okay.
Move
So
the
we're
cash
not
instead.
gonna, right, just gonna keep it.
Yeah, 22.6.
I'm fine with that.
Second.
Second, I'll second that.
I'm going for it.
Okay, all in favor?
Aye.
Opposed? No? Okay.
Great.
Excellent. Anything else for us? Great or exciting?
Nothing on the pension.
No, do you, if we could, do you want to go in executive session? You could talk to us about what's great and exciting in your life?
If I had something great and exciting, I would certainly preach it to the world.
You know, so is there anything else that anybody would like to discuss? And if not,
Will we adjourn?
motion for adjournment,
Second.
all in favor?
Aye.
Opposed? No, that's unanimous. We have an OPEB meeting.
Yeah.
Okay. We'll call the meeting to order and seek approval of the minutes from December 14th, although that's incorrect. It's supposed to be March. Oh, this is the March 8th one. I have the wrong one. I'm sorry. The minutes from the March 8th meeting, which I read over. They seem to be fine. Motion to accept the minutes from March 8th.
So moved.
Second.
All in favor? Aye.
Aye.
Perfect. This one here doesn't call for requests from the public, so I'm not gonna have to do that. And then we're gonna do the performance review, which is pretty simple.
It is. I will pull up the April flash. I'm not sure which tab. It's
Tab 2.
that's the full report.
Is it 4?
Yeah.
Just 4.
So we turn to third page, just showing the assets up to almost 127 million. You can see slight underweight to equities, really due to non-US equity performance over the last few years, as US equities done very well. Slight underweight to fixed income. And we did raise cash, as Chitsmay did expect to pay benefit out of this fund, but they have not come out yet.
Does she want money out of, because we took money for, she estimated to be 6 months.
Right, it just hasn't hit this stage. I don't think she's made the,
And what is, do you know how much the city's contributing to this, if they are?
I don't think they are.
Oh, they're not gonna
I
contribute?
don't believe so. Or if they are, it's a very small amount.
Yeah, I think it's like overfunded, right?
And it's not on the same schedule as the pension, if I recall correctly.
I think it is on the same, I might be wrong, but I thought it was on the same, but if they're not giving any money, that's fine. And Jitsi doesn't need any money until September,
Correct. Correct.
so everything,
Yeah, everything's good. There is a overweight to cash. It is earning something, but waiting to be used to pay those benefits.
Wasn't it overfunded in the actuarial review?
It was.
yeah.
Yeah. Okay.
I mean, one of the things we're now drawing down, which we didn't do until this year.
Right.
Right, and we have to keep more cash, because I'm not sure exactly what her drawer is, but I think it's about $1 million, isn't it? $1 million a month or something like that.
That's what she requested. I
Right.
think, I just don't know the timing of when that's going to be deployed.
Right. So this is a number, so this is a number for April, and she's got $6 million.
Yep.
That
And she did
carries
not-
her into September, and then we'll probably need more money then. Well, and we have money in fixed income.
Why is the cash performance actually less for this account versus the other one?
My guess is it's because it's a different type of plan legally, and what it's eligible for at Northern Trust might be a different fund. So being a defined benefit pension plan, that type of plan is certainly eligible for specific funds within Northern Trust, and I believe this is classified differently and is invested in a slightly different cash fund.
Yeah, can you, will you be able to check with the Northern Trust though about, like, I mean,
We certainly
because-
have those details. I just have to dig them out.
right, they should be able to just buy it, if we wanted to buy, say, treasury bills. I mean, they could just put in a bid for us to the treasury, right? I mean, that's what,
Well, they're set up as a custodian.
right, I know, I don't know whether they can do that or not, that's
Yeah,
all.
I
It
just think
doesn't,
they can't.
you know, I only know one institutional plan who's done that. And one of the members of the board has his own asset management firm, and he accepted like fiduciary responsibility to have his firm trade on behalf of, otherwise the custodian
They're
won't,
the custodian.
yeah, they're not,
Yeah, I
gonna
didn't know whether they can do that or not.
they won't do it.
Because they do
for-
move, I mean, they do move the money around.
Right.
For us, I just didn't know
On our
whether
instruction.
moving the money around would,
Yeah.
include.
Yeah.
Saying, okay, we're
Right.
buying T-bills, That's all.
We'll confirm.
yeah,
Yeah,
Because the alternative would be to, if you wanted to do that, we'd probably have to do that, exactly that, hire a
exactly.
manager to do it.
Who's willing to take on fiduciary responsibility, risk, et cetera, and you'd have to
For
pay
not
them.
much money.
and we don't want to pay a fee for that.
And they would charge.
For a couple basis points on 5 million.
Right, this other one was doing it,
Yeah.
right, pro bono, yeah.
So in terms of performance, fiscal year date's been strong for the OPEB. Passive indexes in US and non-US have both done well. Some tracking error in the international stock fund due to fair value pricing, which does smooth out over time. And then you can see your fixed income managers have added value over the aggregate index, and PIMCO has performed well. So largely the fund's done very well, up 7.9% fiscal year to date, and longer term continues to perform within expectations.
Any questions on OPEB?
And Frank, we're gonna do these quarterly going forward, right?
Yeah, that was just one of the suggestions that we.
Yeah,
lighten up on
okay,
this, 'cause
everybody's comfortable with that?
Yeah.
It's amazing how simple this is and how nicely it performs.
Yeah,
I mean, one of the things that's interesting is OPEB, we've always kept it real simple,
Yeah,
and it's outperformed,
It's done great.
which is wonderful,
I agree.
you know. Is there nothing else? Motion for adjournment? Second,
I'll
all in
second that.
favor? Aye. Opposed? No? That's it? We're off. And now we can